There's a parent-child tax trap when gifting property, and it caught out a father and daughter on a gift of a renovated cottage to the tune of 33 grand. The father had bought a rundown cottage for €100,000. He was quite handy. He spent 2 years doing it up himself, evenings, weekends, almost entirely his own labour. Then he fell into a tax trap. You see, on the transfer of the property, revenue didn't care what he actually received, which in fact was nothing. For tax, they value transfers between relatives at market value. What happened was he took what was a derelict cottage and carried out a significant amount of work to it. He loved his daughter, and by the time he'd finished, the cottage was in show house quality and had doubled in value. So when he gifted it, revenue said, "We're taxing you on the increase in value, and at 33%, that'll be 30 grand, please." He got hit with capital gains tax, or CGT, on money he never saw, based on the increased value due to him. When he pressed his case claiming a deduction for this, they said, "You can't claim a deduction for your own work, never have been able to." His sweat equity, it was worth nothing in the end. He couldn't believe revenue were looking for 30 grand plus interest and penalties, but there's an old UK case from the 80s that proves it. It was the same situation and it led to the exact same result. The only deductions revenue will allow are actual payments. Now back to the father. His tax position would have been better if he'd gifted the property first and then done the work. Play revenue at their own game. They can't tax his effort if the increase in value happens when the property is owned by the daughter. The tax in this case was totally avoidable. If gifting property to your children, get tax advice from an expert.